Hi everyone, we are starting the third discussions of our revision series of FRG paper. Today also we have arranged a paper for the discussion which includes some MCQs questions, also one question from consolidation, also some additional questions from financial instruments. I just thought of giving some additional emphasis on financial instrument because it's going to be part of your a major part of your curriculum syllabus area. We'll get on with the MCQ part, section A. The first 5 questions of MCQ 10 questions are based on a small scenario. Let's go through the scenario first. During the following scenario relates to question number 1 to 5. During the year ended 31st December 18, LPLC built an extension to its head office. The costs associated with the construction of the head office extension are as follows: land acquisition 10 million rupees, fees for environmental certifications and building permits 0.5 million, architect and engineer fees 1 million, construction material and labor costs including unused material 6.6 million. At 30th September 18, the date when the head office extension became available for use, the cost of unused materials on site amounted to 0.5 million rupees. At that date, the total borrowing cost incurred on a loan was used to specifically finance the head office extension amounted to 0.8 million rupees. LPLC also acquired 100% of a subsidiary S company on 1st January 18. The carrying amount of the assets of SPLC company in the consolidated financial statements of the LPLC group at 31st December 18 immediately before an impairment review were as follows: Goodwill 1.4 million, brand name 2 million, property plant and equipment 6 million, current assets 2.4. Total carrying value is at 11.8 million. The recoverable amount of SPLC was estimated at 9.6 million rupees at 31st December 18, and the impairment of the investment in SPLC was deemed to be 2.2 million rupees. Question number 1. For the year ended 31st December 18, how much should be capitalized in respect of the construction of the extension to the head office building? Now, to calculate the cost of the building constructed, so you should go on adding only the directly attributable cost incurred in preparing the asset to the required level. Since it was not a purchase transaction, rather a self-constructed building, the cost to be accumulated in deciding the cost of the building under LK 16 should be the directly attributable cost in preparing the asset to the required level. Now, this land element cannot be considered to be a separate item of assets because the extent of the land would have been fully exhausted for the construction of the property. So, even the land element has to be considered to be part of the cost of the building. So, let me start with that. Land cost has to be 10 million. Fees for environmental certifications and building permits, and you know, if it is within the urban area, just because you want to construct the building, you can't do it on your own accord unless you get the permission and the approval from the parties, authorities concerned. So, even that is a directly attributable cost. If not for the construction, this cost does not arise. And you start constructing the building, that cost arises. So, as a result, you can question yourself whether is it kind of a cost which can be avoided from if not for the construction of the asset. So then if you question yourself, it is a self answered question, yes. If we did, I mean, unless for the construction, if not for the construction of the asset, this is not a kind of a cost to arise. So then this is also a directly attributable cost, 0.5 million. Architect and engineer fees. Before the construction of physical work, you need to have the plan, you need to get it drawn, you need to get an architecture to draw it, and that has costed to the company 1 million rupees, a directly attributable cost. Why? If not for the construction, this cost would not arise. And if you do the construction, this is a cost which you can't avoid from, directly attributable cost, 1 million rupees. Construction, material and labor cost altogether, material plus labor cost 6.6 million should be taken by a directly attributable cost in preparing the asset to the required level. And towards the end of the year, or maybe at the end of the construction, at the site of the construction, there are some materials not utilized for the construction. So 6.6 million is the total amount spent on material, and this 6.6 material cost has not been exhausted for the construction. 0.5 million has not been used. So then you need to take only the materials consumed for the construction. We will take 0.5 million out. What is it? The value of the materials not exhausted, not consumed for the construction of the building. And apart from all these costs, we have another finance cost element involved. What is it? Apparently, the construction has been financed out of a borrowing for which we have incurred a borrowing cost of 0.8 million rupees, and that is done based on LK's 23 borrowing cost. So this borrowing cost seems to be a directly attributable cost incurred on a qualifying asset. You know what a qualifying asset is. Building seems to be a qualifying asset, no doubt. So without being hesitant, we can take 0.8 million rupees borrowing cost as well. So that's all about it, and see what the final cost has to be. Let's keep adding those items of cost incurred and we'll conclude the final amount. 10 plus 0.5 plus 1 plus 6.6 minus 0.5 plus 0.8. The total cost is 18.4 million. So 18.4 has to be the total cost of the building. So the answer has to be part A, 18.4 million, the cost of the building, directly attributable cost until the building was prepared to bring it to the required level. Question number 2, LPLC incurred further expenditure on the head office extension after it had been completed, which of the following would qualify as capital expenditure? This capital expenditure is an expenditure that can be added back to the carrying value of the asset subsequently. You know, LK 16 has been very clear on the facts given. After the asset being taken to the required level, then the cost incurred further on the asset subsequently cannot be normally added to the cost of the asset. Instead, subsequent expenses are normally charged to profit and loss as just a maintenance expenditure. But of course, having said that, the standard goes ahead to explain there are some instances where the expenses incurred subsequently need to be added back to the carrying value, provided that particular subsequent cost contributes not just to maintain the asset but to increase the economic benefits. And I must make it more clear. Say at the beginning we incur 10 million rupees to construct an asset or to buy an asset, and the asset is where we wanted the asset to be, it's at the intended level. Also, this is a machine. Now, it is operating at the optimum level of effectiveness and efficiency, and we manufacture 1 million item. This is the best and this is the optimum level, and nobody can cross this border. Whoever who has this kind of an asset can get only 1 million items a year, and that is the best, that is the maximum, that is the optimum level of efficiency and effectiveness. So, one item can be sold at say 1 rupee, so your say 5 rupee, and your income for a year is 5 million. Now, this is where we wanted this asset to be, to get 5 million economic benefits, cash flow for a year. Sometimes halfway through the lifetime, you know, the asset breaks down and you need to repair it. By repairing, what do we do? Say in the 4th year, the asset collided with another asset and there are physical damages. It does not work now, even after getting to use, that gets stuck. So, you just thought of making some repair expenses of 2 million rupees. And even after incurring 2 million rupees, you won't get anything extra. It is only just that you bring this asset back to where the asset was before, back to the previous level, previous condition, without expecting this asset to generate or contribute anything extra. But then in the 5th year, we did an upgradation to the asset with another cost of 5 million rupees. And following to the upgradation, we have observed that this asset makes not just 1 million item, that has started giving us 1.2 million items a year, and your income for a year increases by 20%. So, the previous expenditure in the 4th year contributed just to maintain the same level of economic benefits. So, we consider it as what it is considered to be just a maintenance expenditure, and you should charge it to profit and loss. Maintenance does not mean the maintenance of physical look of the asset. You should maintain economic benefits estimated originally, economic benefits assessed originally. But here in the 5th year, we have incurred another cost for the upgradation with a cost of another say 5 million rupees, and following in consequent to this upgradation cost incurred, we have seen a major impact in your cash flows, major change in the cash flows. It increases by 20%. So, then the cost incurred in the 5th year for the upgradation cannot be simply just a maintenance cost to maintain the same level of economic benefits that has contributed to generate economic benefits, something extra which we did not expect at the beginning. So, this is a cost that contributes to generate extra economic benefits in excess of what was estimated to generate at the beginning, and this cost is added to the cost of the asset, not just as an expenditure to the profit and loss. It is not just a maintenance expenditure. So, it is only just that you need to see whether it is kind of a cost that will just contribute to maintain the same level of economic benefits, or whether it is kind of a cost that will contribute to generate economic benefits in excess of what were estimated to generate at the beginning. So, that it is only just that to see whether we maintain economic benefits, so we generate additional economic benefits, and that is the criteria to decide how the subsequent expenses should be accounted, whether it is maintenance to profit and loss or whether it is a capital nature expenditure. Now, the expenses incurred, first one, property insurance premium incurred, that does not contribute to any additional economic benefits. It will contribute to maintain the same level of benefits. So, that has got nothing to do with the economic benefits sometimes. B, installations of new office fixtures and fittings. We are installing, fitting some office furnitures, and you can wonder how it can generate economic benefits by fitting and fixing furnitures into the building. It is quite obvious why. Apparently these furnitures and fittings will not contribute to an economic benefit, but what if you sell a building which do not have fitted furnitures? Your selling price can be lower. What if you fit the office furnitures first and then you decide to sell? The selling price can be much more bigger, way more bigger than the selling price of a building where the fixtures and the furnitures are not there. So, here by way of a higher selling price, you can generate more economic benefits if you install and fix the furnitures into the building. So, that will contribute to generate more economic benefits. Marketing cost, telling the public that the head office extension is operational, that has got nothing to do with the economic benefits, it does not contribute the asset to generate more economic benefits. Maintenance and relocation of computers and related office equipment, we bring computers from one place to another, and that does not contribute to any economic benefits either. So, the correct answer has to be part B answer, installation of new office fixtures and fittings. Question number 3, at 31st December 19, the directors of LPLC decide to adopt the revaluation of LK16 property, plant and equipment for LPLC property. In accordance with LK16, which of the following statement is false? And you must understand the question. You should emphasize and convince yourself. They want us to find the negative answer, not the positive one, false one. So, you need to find the accounting treatment of these 4 which does not fit into the prescriptions and treatments of accounting in LK16 property, plant and equipment. And this is where sometimes we make some blunders and mistakes. We do not pay our proper attention to the requirement of the examiner, and your minds may be preoccupied. Maybe you are searching the positive one, whereas the examiner wants completely the negative one. First one, in subsequent years the depreciation will be based on the revalued amount of the head office building as opposed to its cost. Say your building was originally at 5 million, and book value in 2 years time was 4 million, and we started depreciating it over 10 years lifetime at a stretch. In 8 years time, this is the book value, and this was revalued from 4 million to 4.8 million. Now, just because you revalue to make it equal to the existing market values for some reason, it does not mean that even the lifetime of the asset has got revised, unless the examiner says in a questions at the exam, unless the examiner says otherwise, the lifetime is assumed to have been the same as we assessed originally. So, 10 years out of 10 years, 2 years gone, this 4.8 has to be depreciated over the remaining 8 years period. So, subsequent to the revaluation, your depreciation should be based not on the historical cost but on the revaluation. So, the first statement is absolutely correct. Second one, any revaluation gain on the head office building is recognized in other comprehensive income, and any revaluation loss is recognized in profit or loss. And you heard of fair value model and revaluation model. So, how do we differentiate revaluation model from the fair value model? It is quite straightforward. Revaluation model requires the assets to be depreciated even after the assets been depreciated, and fair value model does not require the assets to be depreciated, and revaluation model requires revaluation gains to be taken to other comprehensive income equity unless it is a reversal of another previous revaluation loss. And under revaluation model, you recognize losses to profit and loss unless it is a reversal of a previous revaluation gain. But in fair value model, you should recognize all ups and downs of fair value to profit and loss indiscriminately. So, the second statement is also correct, why in subsequent years the any revaluation gain on the head office building is recognized in other comprehensive income, and any revaluation loss is recognized in profit or loss. That is also correct. Each component part of the building, head office building, is revalued separately. Fourth one, the residual value and the useful life of the head office building must be reviewed each year. Even the fourth one is correct unless it is an SME. LK16 requires the lifetime and residual value to be reviewed at least annually. More frequent the better, but at least the bottom line, the minimum requirement is to review the residual values and the lifetime at least annually. So, A, B, D, they all are correct, and the false statement seems to be third one. Each component part of the building, head office building, is revalued separately, and that is not what is required by LK16. If the asset is not a complex asset where different components have different lengths of lifetime, then you should revalue the building as one single asset without each component being revalued separately. So, the answer has to be third one, C. Question number 4. Assuming its company represents a cash generating unit, what is the carrying amount of the brand at 31st December 18 following the impairment review? Now, let us get back to the scenario, the facts. The first 5 questions are based on that. Now, the carrying value of the CGU is 11.8 million. Recoverable amount is given 9.6. You know, the carrying value of the CGU cannot be recovered from the future cash flows. 11.8 minus 9.6, it is 2.2. So, we have to recognize an impairment loss of 2.2. Now, if it is a CGU, you should allocate the impairment losses to the individual assets of the CGU except for the inventories, except for financial assets, except for investment properties carried at fair value, except for biological assets, except for the non-current assets held for sale, except for plan assets under a defined benefit plan of case 19. So, those assets are not here, and of this 2.2 million, the allocation of impairment losses to individual asset has to commence with the goodwill. So, that is the most sensitive asset in the CGU, which is considered to be first impaired ahead of all the other assets. So, of this 2.2 million, you should allocate 1.4 to goodwill. 1.4 million should be allocated to goodwill. So, the balance is 0.8 million, and this is what you should allocate to the other assets. What do you mean by other assets? Brand name, property, plant and equipment. Current assets are not deducted for impairments under LCS 36. There are reasons, I can't explain all the reasons here due to time constraint. So, let us forget about the impairment loss being allocated to current assets. This 0.8 million should be allocated to brand name and property, plant and equipment on pro rata basis. So, it is 8. Now, brand name is 2, 2 divided by 8 into 0.8. So, the amount of impairment loss to be allocated to brand name should be 0.2, deduct it from the brand name. 2 minus 0.2 is 1.8, 1.8. So, the carrying value of the brand name after impairment loss being allocated should be 1.8. And let us go to the question. That was question number 4. See what the correct answer should be. Answer has to be D. 1.8 million should be the carrying value of brand name after recognizing impairment. Which, if any of the following statements regarding impairment are correct? First one, at the end of each reporting period, an entity should assess if there is any indications that assets have been impaired. Annual impairment reviews are required on all intangible assets with indefinite life. You know, LCS 36 talks about two kinds of assets basically. The assets that require annual impairment review and the assets that require impairment reviews only when there are indications. You get indications from multiple sources just to make you understand that the future cash flows are lower, so the carrying values cannot be recovered from the future cash flows. And those multiple information will be taken basically into two internal sources and external sources. LCS 36 says there are 3 assets that require annual impairment reviews. Goodwill arising in a business combinations, and the standards are logics. For every damn accounting prescription they have given a reason, and you do not get accounting treatment randomly, and there are reasons for every accounting treatment. Also, LCS 36 requires annual impairment reviews to be done for the intangible assets with indefinite lifetime. where the lifetime is not certain. Also, you need to conduct impairment reviews for the financial assets that are not yet available for use. So, there are reasons why annual impairment reviews are required for these three assets, and you need to refer to the standards. I can't explain the reasons right now. So, the second statement is very clear, it is true. Then the first one, at the end of each reporting period, an entity should assess if there is any indication that assets have been impaired. Indiscriminately, irrespective of whether it is kind of an asset that requires annual impairment review or otherwise, you need to see whether there are indications that will show that the future cash flows are not as much as we expected. Future cash flows have come down. Even the first statement is accurate. So then the answer should be one only no, second only no, both 1 and 2 years. Correct answer should be C. First and the second, both statements are accurate. Now, starting from question number 6, you need not to refer to the scenario given at the beginning, and these are standalone questions with the scenarios individually given for each question. In accordance with LCS 32 financial instruments, presentations which of the items in the trial balance would be classified as financial instruments. You know, to define financial instrument, you should first define financial assets and financial liabilities. If you go through LCS 32, there are 6 definitions for financial assets and 4 definitions for financial liabilities. To understand this entire picture and the concepts of financial instruments, you need to learn altogether 10 definitions, then only you should know what financial assets and what financial liabilities are. But then the little knowledge you have now will be adequate to answer this particular question, to identify the financial instruments. Now, when it says a financial instrument, that is like a collective noun. You should include assets and liabilities both together. Closing inventory is not a financial asset. If you define the financial assets using all the 6 methods, it is not a financial asset. Trade receivable, yes, it is why we have the contractual right to receive cash. 5% loan notes, if you issued loan notes at 5% interest rate, that becomes a liability. Also, it becomes a financial liability. Why? We have the contractual obligation to deliver cash, has to be a financial liability and a financial instrument also. Property, plant and equipment, not. So, there are only 2 items here that fall within the definitions of financial instruments: trade receivables and 5% loan notes. So, the answer has to be C, trade receivables and 5% loan notes only. Question number 7. DPLC has inventories of 8.6 million. On 31st December 18, inventory is 8.6 million. The inventory count had 2 issues: products with a sales value of 0.6 million had been incorrectly excluded from the count. Also, items costing 0.2 million which had been included in the count were damaged and could only be sold for 50% of the normal selling price. DPLC makes a markup of 50% on both of these items. Product with a sale value of 0.6 million had been excluded from the count. Now 0.6 million is the selling price, but you should include that into inventories at which value? At the cost. So we are given the markup. Markup is 50%. If you calculate the cost, 0.6 divided by 150 into 100, that is 0.4. Add it. It is excluded. Products with a sales value of 0.6 million had been incorrectly excluded, so you need to include into the inventories not at the sales value, at the cost. Cost has to be after the markup. So you divide 0.6 million by 115 to 100, you get the cost. Then also items costing 0.2 million which had been included in the count were damaged, could only be sold for 50% of the normal selling price. Now it is an instance where inventories are written down from cost to NRV. Cost is 0.2 million. NRV has to be calculated. To calculate the NRV, you need to first add the markup 0.2 into 150%, that is 0.3. But NRV seems to be just 50% of the normal selling price. So we will divide it by 2 now. It is 0.3 divided by 2, it is 0.15. So what you must do is to write down inventories from cost to NRV, or to remove the cost and then to include NRV. So I will deduct 0.2 from inventories and add 0.15, that is for my convenience. 8.6 plus 0.4 minus 0.2 plus 0.15. So inventory value seems to be 8.95, and the correct answer has to be A. What is the correct carrying amount of inventory to be recognized in D company's financial statements? That has to be 8.95 million. 8.95 million. Question number 8. In an attempt to improve reported profit, the directors of DPLC company want to change valuation in method of inventory from FIFO to an average method. Which, if any of the following statements regarding the potential change in inventory valuation are correct? The change will represent a change in accounting estimate. The financial statements will be adjusted prospectively. Now, LCase 8 talks about changes of accounting estimates, accounting policies and errors. You know, sometimes we find it difficult to differentiate or to distinguish the changes in accounting policies from the changes in accounting estimates. Now, I can give you some easy methods to identify as to what an accounting policy change has to be. If you decide to change the accounting method for an asset or liability within the same economic environment, if you decide to change the accounting method for an asset or liability while the asset being held within the same economic environment. What do you mean by same economic environment? The asset or the liability contributes the same cash inflow or an outflow, then that becomes an accounting policy change. But if you decide to change the accounting method for an asset or liability to adapt to the changing economic environment of an asset or liability, and that does not become an accounting policy change. Say for an example, you have the factory building for which you started adopting the cost model from the beginning, and later on for some reason or other you thought of applying the revaluation model. Still the building is used to run your factory. So, the economic environment of the building has not been changed. That contributes to a particular cash flow. When you adopted the cost model, when it was under cost model, even after you changing it over from cost model to revaluation model, still the building continues to make the same cash flows by contributing to the manufacturing process of the business, same economic environment, but you are changing your accounting methods and the accounting methods. So, that is going to be what accounting policy change. What if a building has been rented and was recognized under investment properties? Now it is used to run your factory. Now the building used to generate a rental income cash flow before, now it contributes to the manufacturing process now. So, different economic environments. Previously you have adopted fair value model under investment properties. Now you decided to apply cost model for property, plant and equipment, that is the policy for property, plant and equipment, and you change your changeover from cost model to your changeover from fair value model to cost model for the same asset will not be an accounting policy change. Why? You are changing your accounting method, you are adapting the accounting method to the changing economic environments of the asset. So, that is not an accounting policy change. Or if you change your accounting policies, accounting methods relating to the valuations of assets and liabilities, once again that is an easy method to identify what accounting policy changes are. Now, inventory valuation from FIFO to weighted average is an accounting policy change. Why? That is relating to the valuation methods of assets. And if you do that change, if you change over from FIFO method to average method, your financial statements need to be restated and you need to apply retrospective application, and you should apply the new accounting method for the inventories to make it look it is FIFO method that has ever been in use and the practice, not the it has to be corrected. We are changing from FIFO to average cost. You should change your accounting method and you need to restate your financial statements to make it look as if it was the average method that has ever been in use and in the practice of the entity, not FIFO. So, you should go back to the previous years, should start changing your financial statements from the very first year in which the previous method was used, and you need to go on changing the financial statements until the current financial year. So, we call it retrospective application. So, since this is an accounting policy change, retrospective application is what is required. So, you need to go on changing the financial statements from the previous years right up to the current year. So, this is not an accounting policy change. The first one is wrong. The financial statements will be adjusted prospectively, even that is wrong. Prospective adjustments are done where there are changes in accounting estimates. Where there are policy changes, it has to be retrospective applications. So, both statements are wrong. So, the answer has to be D. They want us to find the correct answer. Both statements are wrong. So, the answer has to be D. Question number 9. DPLC entered into a factoring agreement with FPLC on 31st December 18. In accordance with the agreement, DPLC sold trade receivables with a carrying amount of 6.2 million. Carrying value has been 6.2 to FPLC for 6 million. Under the terms of the factoring agreement, after 6 months, FPLC will return unpaid receivables to DPLC for collection. FPLC will also agree DPLC a fee of any uncollected balances at the end of each month. Which of the following statements regarding the factoring arrangement is not true? Is not true, so you need to find the false one. Now, if you go through the contents of the question once again, so basically this is given from financial instrument derecognition part. There are lot of and multiple instances where the financial assets are derecognized, and we discussed some of them in our previous webinar series. You need to get back to those and to recollect your memories, refresh yourself before you attempt this question if you are not sure about the answer. Now, the financial asset debtors are recorded at 6.2 million here. You factor it and you have collected 6 million rupees. But in 6 months time, the factoring company will transfer any uncollected debtors back to us, back to DPLC. What does it say? Maybe the terms and conditions agreed upon with the factoring company are such that factoring company is not prepared to take over the risk of debtors. Default risk is not taken over by the factoring company. So they will push the customers, go behind the customers, and they must be knowing and would have developed the practice of collecting money from the customers, which we do not know. So we give them the task and the activity of collecting money from the customers and give us the amount, and after deducting whatever they have to deduct for themselves. But unpaid debtors will be returned back to us because they do not take over the risks of the customers, and it's we who should take it over. Now, in your technical jargon, we call it the debtors were factored with recourse. We take over the responsibilities. It's not the factoring company who takes over the responsibilities. So, since we have not transferred the risks and rewards of the financial asset to the factoring company, you cannot consider that to be a sale. It's not a genuine absolute sale transaction. Why? It's we who retain the risks and rewards of the financial asset eventually. If it is not a sale where the risks and rewards have been transferred to another party, you cannot derecognize. If it is not a derecognition, the selling company DPLC should continue to recognize the financial asset. And the proceeds you received cannot be the sales proceeds, should be loan proceeds. You should recognize them into another financial liability. And 0.2 million is like your finance cost. Why? It's like you're receiving a finance facility at 6 million rupees to pay it at 6.2, and if you apply SLFR is 9, this is a financial liability. Proceeds received from the factoring company should be a financial liability recognized under other financial liabilities, and you should measure them at amortized cost, where you should also to determine the effective interest rate. So, this 0.2 million will be recognized into profit and loss as a finance charge over the period of maturity, and you need to also work out on effective interest rate. So, that is the scenario in nitty-gritty. That is what has really happened in nitty-gritty. And without just looking at the legality of the transaction, let's see how the accounting should be, just to demonstrate, just to exhibit the economic reality of the transaction. First one, a 6 million received should be recorded in the liabilities of DPLC at 31 December. That is true, that is correct. So, they want us to find the false statement. 0.2 million should be expensed in DPLC statement of profit or loss for the year ended 31 December 18, and that's bit of a contentious matter. Let us look at the others. A total of 5%, a total of the 5% monthly fee should be expensed in DPLC statement of profit or loss for the year ended 31st December 19. And D, the receivables will remain as an asset in the balance sheet of DPLC. In the balance sheet of DPLC as of 31st December 18. There has to be a small correction to the question. FPLC will also charge DPLC a fee of 5% on any uncollected balance at the end of each month. Please do the correction. And then even the third one is a correct statement. So the false statements has to be B. 0.2 million should be expensed in DPLC statement of profit or loss for the year ended 31 December 18. Without it just being expensed, you need to recognize it as the finance charge. It is the finance charge, effective interest. You need to work out effective interest rate and to amortize it over the maturity period. So we will get on with question number 10. The 5% loan notes were issued for 9 million. On 1st July 18, DPLC incurred issue cost of 0.5 million. So this is a financial liability for DPLC. Initial measurement should be 9 million irrespective of the classification. DPLC incurred issue cost. 0.5 issue cost has to be deducted. Remember, you cannot deduct the issue cost from the fair value and to show 8.5 net amount, you can't do it. Why? If you deduct the transaction cost from initial fair value and show, that is a complete breach of SLFRS 13. Fair value has to be measured without including the transaction cost. Why? Transaction cost is not feature of the financial liability, it is coming from another transaction. So you need to bring fair value first and then to deduct the transaction cost from here separately. Then the loan interest is payable each 30th June, and the loan note is repayable at a premium giving an effective interest rate of 8%. In respect of the 5% loan notes, how much should be expensed within DPLC statement of profit or loss for the year ended 31st December 18? You know, to charge interest to profit and loss, the interest rate you should apply should not be the coupon. To recognize interest to profit and loss, the interest rate you should apply should be the effective interest rate. So effective rate is given, luckily. If it was not given, you need to work out on IRR to find out the effective interest rate. So it is 8%. So now 8.5 million into 0.8%. But for how many months we have done the issue on 1st July? What is the year end 31 December? And you should recognize interest only for just 6 months time. 6 months time should be 0.34 million. So the answer has to be D. D is the answer. 0.34 million should be the amount of interest to be charged. Right. So we are moving on to section B now. Section B. Question number 2, section B. BPLC offered directors an option scheme conditional on a 3-year period of service. The number of options granted to each of 10 directors at the inception of the scheme was 1 million. The options were exercisable shortly after the end of the 3rd year. Upon exercise of the share options, those directors eligible would be required to pay 2 rupees for each share. The fair value of the options and the estimates of the number of options expected to vest at various points in time were as follows. Rights expected to vest, fair value of the option, start of the year 1, rights expected to vest 8 million, fair value of an option 0.3, end of year 1 7 million, fair value is given, end of year 2 8 million, fair value is given. At the end of year 3 9 million rights actually vested. Required, show how the option scheme will affect the financial statements for each of the 3 years of the vesting period. Show the accounting treatment at the vesting date for each of the following situations. The fair value of a share was 5 rupees and all eligible directors exercised their share options immediately. The fair value of a share was 1.5 rupees and all eligible directors allowed their share options to lapse. So, the question is fragmented into 3. Now, the question is given from SLFRS to share based payment transactions, and this is under equity settled share based payment category, equity settled share based payment category. And you identifying whether it is equity settled category or cash settled category will be extremely important. Why? The measurement criteria will be different. If it is equity settled share based payment transactions, you should measure it at fair values of equity items granted on the equity items to vest, rather at the fair value of equity items on the granting date, fair value of equity items on the granting date. Why it is measured at the fair values of equity items on the granting date should be explained with reasons, but we should not go to that extent because of the time constraint. Now, the vesting term is 3 years. First year, you should recognize expenditure plus equity. Second year also you should recognize your expenditure plus equity. Third year also you should recognize your expenditure plus equity. Now, the number of options to vest as estimated at the beginning of year 1 is not something which is required. So, you should look at first the number of equity items to vest at this point, I mean end of the first year. What is your estimate? It is 7 million. 7 million equity items to vest. And what is your measurement basis here? It has to be the fair value of an option on the granting date. Granting date is the start of year 1, this is 0.3. And this is supposed to be my total expenditure over 3 years time. So, you divide it by 3 into 1. Let us take the calculations. 7 million into 0.3 divided by 3, expenditure for the first year should be 700, and you should credit that to equity 700. Why is it equity? If you look at the definition of financial liabilities under LKS 32, this has got nothing to do with financial instrument, but clear to understand, a derivative contract, option is a derivative contract which is settled by issuing our own equity shares. Yes, eventually we are going to issue our own equity shares. The number of shares to be issued should be a fixed number. the amount of cash to be received should be a fixed amount of cash, and the value of the derivative contract goes to equity. That is the reason. Second year end, what is your expectation? 8 million, and this is multiplied again at fair value of options on the granting date. It is divided by 3 into 2. Let us take the cumulative equity figure. This is divided by 3 into 2, it is 1.6 million minus 700,000, it is 900,000. End of the third year, the vesting date, third year end, on the vesting date, 9 million rights have actually vested. 9 million into 0.3 divided by 3 into 3. 9 million into 3.3. So, the cumulative equity figure should be 2.7, out of which 1.6 has been expensed over the first 2 years. So, the residual amount is expensed now into the third year. 2.7 minus 1.6, 2.7 minus 1.6 is 1.1 million. So, this is how you recognize expenditure and equity over the vesting periods. That is the answer for part 1. And part B, show the accounting treatment at the vesting date for each of the following situations. The fair value of a share was 5 million, 5 rupees, and all eligible directors exercised their options immediately. Now, in this equity account, we have a credit balance of 2.7 million rupees now. Under the options, the directors have the right to buy a specific number of shares at a specific price. Now, the value of a share is 5, but directors are supposed to pay only how much? Directors are supposed to pay just 2 rupee for a share. 2 rupee for a share at the point of the exercise. If all the directors exercise their rights to buy shares, let us see how the accounting should be. Now, cash payment, receipt of cash to the entity, you can debit to cash account. It is 9 million shares to be issued, and for each and every single share, the directors have to pay 2 rupees, should be 18 million. Where do we credit? Credit to share capital, there is another debit entry. Credit to share capital. Credit to share capital by how much? What is the value of a share? Value of a share is we will first debit to equity. This equity account balance should be debited by 2.7, that also goes to share capital, 2.7 million. And then the amount to be taken to share capital account. We will take the total amount 18 plus 2.7, you credit 20.7 million to share capital. The amount that you received in cash is 2 rupee for a share. How does it come? 9 million shares into 2 rupee, that is what the directors promised to pay, 18, and we had 2.7 million in the equity account. That has to be the recognition should be transferred to share capital, and the total amount should be transferred to share capital account. So, that is how the accounting should be. If all the directors have exercised their rights to buy shares as agreed at 2 rupee. Third part of the question, or question B, Roman simple number 2, the fair value of a share was 1.5 and all eligible directors allowed the share options to lapse. You know, whether the directors will exercise their rights to buy shares under the option agreement or not depends on the market price of a share. In the previous case, market value of a share was 5 rupee and the directors are supposed to pay 2 rupee. So, it is preferable, or it is advantageous for the directors to pay 2 rupee for a share which is really worth 5 rupee in the market. So, the directors are likely of exercising, while they are supposed to pay just 2 rupee for 5 rupee shares in the market. If the fair value of a share has fallen down to absurd level like 1.5, but if the directors are supposed to pay 2 rupee for a share, we can't expect the directors to exercise the option. Why? They are not prepared to take over a loss. They are paying 2 rupee for a share which is worth 1.5 rupees in the market. So, the directors are unlikely of exercising the options to buy shares under the option agreement. So, then they have decided not to exercise but just to let it to lapse. Then what is the accounting? Here we have equity figure of 2.7 million, fine, and the directors did not exercise their rights to buy shares. You need not to do any accounting. We let this equity figure of 2.7 million to be in accounts all along, and you need not to reverse it either. If you want to reverse, you can de-recognize it from this equity and you can transfer it to retained earnings. If not, you can just let it to be there in the books all along. So, that should be the answer for the second question, part B, second part. We will go to question number 3. Question number 3. SPLC is a company that has issued a public bond. It reports to its shareholders on a biannual basis. TPLC, a company which holds a financial assets until maturity, is one of many investors in SPLC's bond. On purchase, TPLC deemed the bond to have a low credit risk due to SPLC's strong capacity to fulfill its short-term obligations. It was perceived, however, that adverse changes in the economic environment could have detrimental impact on SPLC's liquidity. At TPLC's reporting date, it has access to the following information about SPLC. Sales have declined 15% over the past 6 months. External agencies reviewing its credit rating, but no changes have yet been made. Although market bond prices have remained static, SPLC's bond price has fallen dramatically. Required discuss the accounting treatment of the bond in TPLC's financial statements at the reporting date. Now, there are two companies involved, one is SPLC and the other one is TPLC. We will try to make the facts clear first. SPLC has been the company that issued the bond, so they have a financial liability. Amongst many investors who invested in the bonds of company S is TPLC is one investor, has been one investor. So, TPLC has been an investor in company S because they have invested in the bonds of company S. So, we should now talk about accounting treatment in the books of company T relating to their investments made. Now, at the time T made the investment in the bonds of company S, the credit risk of company S, the credit risk of the bonds of company S is assessed to have been very low at the time of the investment. And say end of the first year, they need to conduct their impairment review for the financial asset in the books of company T. And for them to review their impairments on the financial assets, they need to have access to some information of company S. So, they do have the access to information of company S, and with that information, so they need to make the assessment regarding the level of risk of bonds in company S. If the risk has increased or the credit quality has deteriorated significantly, then company T has to adopt lifetime expected credit loss, and if the risk has not increased, credit quality has not deteriorated significantly, they need to adopt 12 months expected credit loss. So, whether to apply 12 months or whether to apply lifetime expected credit loss is decided based on the credit quality's deteriorations over 1 year's period. Now, to analyze whether the credit quality has deteriorated or not, you are given the information required. What is it? Sales have declined. Sales of which company? Company S have declined by 15%. So, drop of 15% of sales can have a significant impact on the future cash flows. And if this 15% drop in sales impacts to the future cash flows, the investor company T will have a major difficulty of not being able to collect their contractual cash flows. That fact has to be taken account of in conducting the impairment review. External agencies reviewing its credit rating, but no changes have yet been made. That of course is a different matter. They are collecting information and their assessment has not to be taken so seriously for this at this moment. Although market bond prices have remained static, CPLC's bond prices has fallen dramatically. Everyone else's bond prices remain static in the market. Come on, the bond prices of this particular company S have only fallen drastically, and you need to think and question yourself what makes their bond prices fall dramatically. So, there may be some issues. So, taking those two negative factors into account, your judgment should be what? The credit quality of the bonds issued by company S has deteriorated significantly. If the deteriorations are significant, you should apply not 12 months expected credit loss, it has to be lifetime expected credit loss. So, that is your evaluation here, and what is your discussions? You need to highlight these 2 points of sales dropping by 15% and bond prices falling dramatically, and that will result in you applying lifetime expected credit loss for the investment in the bonds of company is not 12 months. Why? That will demonstrate and that will make it clear that the credit quality of the bonds issued by company S has significantly deteriorated. So, that is the conclusion, and you need to conclude that the type of credit loss to apply on the impairment review should be lifetime expected credit loss. Let us continue. Part B. On 1st January 19, NPLC purchased a bond for 1 million rupees, which is measured at amortized cost. Interest is payable at 10%. In arrears. Repayment is due on 31st December 2021. It's with 3 years maturity. Effective rate is 10%. Coupon and the effective rates are the same. On 31st December 19, NPLC received interest. So, we have to receive interest, coupon interest over first, second, third, 3 years. This one has already been received, no problem. On 31st December 19, NPLC received interest of 100. It estimated that the probability of default on the bond within the next 12 months would be 0.5. Probability default is 0.5. If default occurs within the next 12 months, then NPLC estimated that no further interest will be received and that only 50% of the capital will be repaid on 31 December 2021. Discuss the accounting treatment of the financial asset at 31st December 19. So, apparently the kind of impairment review that is needed here is 12 months. Now, that is how the question has been worded. 12 months expected credit loss. So, we expect a default event to occur within 12 months time, and by how much the future contractual cash flows will be reduced as a result of the default event to occur within 12 months time, and that is your impairment review under 12 months expected credit loss. If the default event to occur within 12 months time, we are losing the coupon interest over 2 years time plus 50% of the capital. Then you need to calculate the credit loss. Credit loss has to be the difference of the present values of the contractual cash flows and the cash flows to be received. Easier if you simply calculate the present values of the cash flows to be lost. Here I am losing 100,000. Here I am losing 600,000. Why 600,000? I am not only losing the coupon for the last year, also I am losing 50% of the capital. 50% of the capital is 500,000. Last year interest is 100,000, altogether 600. Let me discount it using the original effective interest rate. Original effective interest rate was 10%, 100,000 divided by 1.1. This is 90,000, 901. 600,000 divided by 1.1 to the power 2. This is 495,868. Let me round it off and take the total 90,909. 90,909 plus 495,868. It is going to be 586,777. This is the credit loss, and your ultimate figure should be expected credit loss. For the credit loss to become the expected credit loss, you need to multiply it by the probability default, probability weighted, and normally, as you do the impairment calculation, it has to be the probability default into loan given default into exposure at default, and those figures are not given, just forget it. If this default event to occur within 12 months time from the reporting, this is going to be a total loss, but the chances of that event happening is only just 0.5%. 0.5%. Now only you calculate expected credit loss. To calculate expected credit loss is multiplied by probability, weighted probability. So then 586, 777 into 0.5%, it is just 2,933, and this is the amount by which the provision for impairment should be created. So that is the answer for part B, question number 3. Then we will quickly move on to question number 4. H has owned 80% of the ordinary shares of S and 30% of the ordinary shares of A for many years. The information below is required to prepare the consolidated statement of profit or loss for the year ended 30th June 18. Statements of profit or loss for the year ended 30th June 18. Revenue given, cost of sales given, gross profit given, distribution costs given, administrative expenses given, profit from operations given, tax given, profit after tax given. There were no items of other comprehensive income in the year. At the date of acquisition, the fair value of SS plant and machinery, which at that time had a remaining useful life of 10 years, exceeded the book value by 10,000 rupees. During the year, S sold goods to H for 10,000 at a margin of 25%. By the year end, H had sold 60% of the goods of these goods. The group accounting policy is to measure non-controlling interest using the proportion of net assets method. The current year goodwill impairment loss was 1,002, and this should be charged to administrative expenses. By 30th June 18, the investment in A had been impaired by 450, of which current year loss was 150. On 1st January 18, H signed a contract to provide a customer with a support services. For the following 12 months, H received the full fee of 30,000 rupees in advance and recognized this as revenue required to prepare the consolidated statement of profit or loss for the year ended 30th June 18. We will quickly write up the format of the profit and loss for the group, and let us derive the required figures. Revenue, cost of sales, gross profit, distribution cost, administration cost, finance cost is not given, profit before tax, share of associate profit, profit after tax, Then say profits attributable to parent shareholders and the profits attributable to non-controlling interest. We will start with adjustments. At the date of acquisition, the fair value of SS plants and machinery, which at the time had a remaining useful life of 10 years, exceeded the book value by 10,000. So, you should recognize extra depreciation arising on this fair value adjustment. Let us see the acquisition date and the reporting date. Reporting date is 30th June. Acquisition date has not been given. It has owned 80% of ordinary shares of S. It would have sometimes back, and we have to charge full year's depreciation. So, the remaining lifetime has been, as it says, the remaining lifetime has been 10 years. So, 10,000 divided by 10, required extra depreciation should be 1,000. Let me add it to administration cost. Administration cost. Then that affects to NCI profit calculation as well. Subsidiary company has a profit after tax of 39,000, and as you calculate the NCI profit for the current year, please make sure you deduct 1,000 and then calculate. Then next one, during the year S sold goods to H for 10,000 at a margin of 25, 60% of the goods has been sold. Let us work out on unrealized profit, and also we will remove intercompany sales and purchases. Revenue is deducted by 10,000, similarly cost of sales should be deducted by 10, and unrealized profit out of 10,000 only 40% remains unsold, so that should be 4,000. So, what does it say? The markup has been 25% margin, it is a margin. So, let me apply 25% on sales value, 1,000 should be the unrealized profit. We will add it to cost of sales, and the selling company has been selling company has been company S, and let us deduct it from S limited profit after tax before you calculate NCI profit for the current year. Non-controlling shareholders were measured at the book values of proportionate net assets. So, the goodwill impairment has been there. How much? Goodwill impairment for the current year goodwill impairment loss was 1,200 added to administration expenses, and this loss has to be taken over only by the parent company. Remember, that is very important to remember. As you calculate the profit share of profit of NCI, you need not to deduct it from S limited profit to calculate NCI profit. Why? Only the parent company should take over the loss. NCI shareholders do not need to take it over. Then there was another impairment in associate of 150 for the current year. Let me deduct it as you take associate share of profit 150. Parent company has entered into a contract to provide a customer with support services for the following 12 months. H received the full fee of 30,000 in advance and recognized this as revenue. the support services over 1 year's time with a total fee of 30,000. So, you need to look at it from SLFRS 15 viewpoint. Apparently, the performance obligations are satisfied over the period of 1 year's time. Then, if the performance obligations are satisfied over the period of 1 year's time, you should recognize over 1 year's time. 30,000 is not recognized at once. You should recognize revenue as and when the performance obligations are satisfied. Out of 30,000, only 15,000 can be recognized into revenue because we would have completed our services over 6 months time. Why 6 months? We entered into the contract on 1st January and the reporting date is 30th June. So, we can recognize revenue only to the extent of the performance obligations having been satisfied. So, we can recognize only 50%, which is 15,000. Balance 15,000 cannot be recognized into revenue. But what these guys have done was they have recognized the total amount of 30 into revenue, which is wrong. So, it is only just that we deduct 15,000 from revenue and that has to be recognized into a contract liability. I suppose that was clear. And then we can go ahead with the balance part of consolidation. Those are the adjustments required, and let us get on with recognition. So, we apply line by line consolidation for the parent company and subsidiary company, and equity method is applied for the associate company. Revenue 500,000 plus 200,000 minus 25, 500 plus 200 minus 25, 675. Cost of sales 100,000 plus 80,000 minus 10 plus 1,000, 180 minus 10 plus 1, 171,000. Gross profit 675 minus 171, 504,000. Distribution cost 160,000 plus 20,000, 180,000 consolidated. Administration 140 plus 40, 140 plus 40,000 plus 2,002, 140,000 plus 40 plus 2,200. It is 177,800. Then let us work out on profit before tax. 504,000 minus 180 minus 177,800, 146,200. Then let us recognize share of associate profit from the profit before tax of the associate, that is 40,000. 40,000 into, it was 25% acquisition in rather 30%, this into 30% minus the impairment, 40 into 30 minus 150, 11,850, and then we will recognize taxation here. Tax has to come 23,000 plus 21,000 plus share of taxation from the associate company, that is 14,000 into 30%. 30%, 14,000 into 30% plus 21,000 plus 23,000, 48,200. We will take the profit after tax. Profit after tax 146,200 plus 11,850 minus 48,200, 109,850. Take NCI profit. NCI should be based on the current ownership of 80%, 20%, this into 20%. 39,000 minus 2,000 into 20%, 7,400. So, the profits attributable to parent shareholders 109,850 minus 7,004, 102,450 should be the profits attributable to parent shareholders. So, we can quickly move on to the last question. Question number 5. On 15 January 2015, the Board of Directors of SPLC voted to proceed with three reorganization schemes involving the closure of 3 factories. SPLC's reporting date is 31st March and the financial statements will be authorized for issue on 30th June. Scheme 1, the closure costs will amount to 125,000 rupees. The closure will be announced in June and will commence in August. Now, this is under LKS 37. To recognize provisions under restructuring program, you need to have a detailed formal plan that should identify at least the business affected and the locations affected and the parties affected, and you should identify approximate number of employees who will be compensated, the approximate amount of compensations to be paid when the plan is to be implemented, and also you should make, there has to be a constructive obligations by announcing or communicating the main features of the plan to the affected parties or by implementing the main features of the plan. Now, everything seems to be alright except for the fact that the plan been announced in June. So, until such time you announce the plan on the reporting date, there is no constructive obligation. So, unless you announced it to the parties affected, a valid expectations has not been created in the minds of the affected parties, stating that the entity will take over the responsibilities to pay their compensations. So, as a result, since the communication part was done after the reporting date, the provisions need not to be recognized for the scheme 1 closure, but you can make a disclosure just to show the effect to the cash flows in the future, and that will be important to some readers. Without it being recognized 125, you can make a disclosure in the financial statements. Scheme number 2, the costs will amount to 45,000 after crediting 105 profit on disposal of certain machines. The closure will take place in July, but redundancy negotiations began with the staff in March 5. Everything has been alright, even the communication has been done right before the reporting date, ahead of the reporting date. So, now even the staff members have been communicated regarding the plan, a valid expectation has been created in the minds of the affected parties to the effect that the entity undertaking their responsibilities to pay off the compensations. So, constructive obligations are existing on the reporting date, so you can create provisions for the required amount under scheme number 2. Scheme number 3, the business, the locations affected were identified, the approximate number of employees whose services are terminated were also identified, the amount of expenses for compensations were identified, the plan was announced to all the affected employees before the reporting date. This is a plan of reorganizations to be implemented in 5 years as a 5-year strategy. Everything has been done perfect, all the requirements were satisfied except for the fact that this is going to be a reorganization plan to be implemented in 5 years time. So, there is a considerable time delay from the date of announcement right up to the date of the implementation. So, within 5 years, 4 years time, the plan can be significantly changed, the plan can be completely withdrawn, and as a result the employees cannot create a valid expectations within themselves that the entity will undertake to discharge their responsibility. So, what will happen, what can happen over 5 years time. LCase 37 says even if all the requirements are satisfied, if there is a considerable time delay for the implementation, the constructive obligations are not considered to exist, so the provisions are not needed. So, even for scheme number 3, provisions are not needed. Why? Because there is no constructive obligations. This is because there is a considerable time delay from the date of announcement right up to the date of implementation. So, that is all about it, and that is the end of the paper. Thanks once again for watching the videos of our revision series. We will meet up again with the 4th discussion.